Hey everyone, it's Imran from Options Insight back with another macro options spotlight. Okay, US stocks finally starting to break down as the supportive option flows that we've been talking about get exhausted. We've got OPEX obviously this morning, and so when all these puts that dealers have been short delta against go to zero, guess what? They cover that delta, and therefore once that delta is covered, there's nothing else supporting the market, and then the market starts to trade lower in line with some of these other macro moves that have been going on, as we've said. Europe did hold up better, but does look vulnerable and has started to head south overnight, along with Asia. Most commodities are still heavy. We're seeing gold continuing to grind lower as well into that support zone that we mentioned. But copper did manage to stage a 3% bounce yesterday, although that has faded somewhat overnight as well with Asia weak. But a 3% rally off that $4 level. $4 does seem to be the battleground right now in copper. For now, it's managing to hold. But with what's going on in macro and the dollar creeping higher, I gun to my head, I'm probably a bit more worried about copper to the downside in the short term. Now, volatility-wise, they did reverse. Obviously, vols had been getting slammed post CPI, etc. They popped again. We obviously saw a PPI number that spooked the market a little bit on the inflationary front. So vols catching a bid there. European vols lagging, but Europe didn't really do a whole lot yesterday, but they have started to catch up as well overnight. Commodity-wise, it was a mixed bag. Realized vols obviously in commodities have been coming down, which is why I got quite a lot of positive carry popping up in the likes of gold and oil and silver as well. As that China reopening trade has kind of been faded, but we've seen spot lower in commodities, but vol lower as well. So spot and vol both going down together in commodities. And then in terms of skew, we've seen a big shift higher in skew on the week here, up quite a bit on the day as well, particularly in US indices. Does suggest some more fragility building to the downside as investors might be less likely to sell back protection quickly like they did last year because they've got longer the market, right? So last year, remember, they were underweight. Even if they thought the market was going to go down and they bought puts, they were pretty quick to monetize and sell those puts. We kind of feel as people have added length back to the market this year, they might be less inclined to sell out that protection so quickly. And then in terms of commodity skew, the only call out is that copper skew collapsed and has flipped back into call premium, which is interesting because that's the only one in our commodity set that has done that. Looking at the other asset classes, the dollar did manage to push a bit higher through that 104 area as PPI data came in hot, yields pushing on as well. We do think this move in the dollar could extend another 2-3% higher, and dollar could still be in a downtrend even if it does that. But we do think that pain trend is kind of in process. Bonds had another tough day. TLT getting down to 101.5. We think it might want to test that 100 level before it actually bounces. But in general, we do think picking up longer dated duration around these levels is sensible trade. We have talked about call spreads on TLT. And then finally, ARC did finally move down along with what bonds are doing. So down 3%. It's been very resilient lately, still up 4% on the week, but kind of starting to catch down with the idea that if yields just keep going higher, these high growth tech names need to react. Volatility wise in FX, we are seeing it come down, grinding lower, seeing lots of positive carry all over the place in FX and also in bonds. So that's going to keep a bit of pressure on volatility. And then in terms of sectors, the only thing in negative carry and moving to justify its vol is XLE right now, whereas everything else is still in the green. Okay, moving on to the charts that we've been looking at. Obviously, PPI came in at 0.7 month on month, which kind of helped yields push higher. Those 10-year US yields approaching that key 4% level. Labor market data does continue to show tightness, initial jobless claims falling, and Fed speakers Mester and Bullard were out opening the door for 50 basis point hikes again. And we've now got 18% probability priced in for the market for 50 bips on the March FOMC. And that was from zero a few weeks ago. Equities finally seem to care about the huge push up in yields. Obviously, we've got OPEX rolling off today. The supportive flows that we mentioned are being removed, and the S&P took out 4,100 support that it hadn't done all week. Okay, PPI came in above expectations, 0.7 month on month, helped yields push higher. Again, 10-year US now approaching that key 4% level. Labor market data also showing tightness, initial jobless claims falling, and Fed speakers Mester and Bullard were out opening the door for 50 basis point hikes again as inflation seems to be reaccelerating. So markets are pricing in an 18% probability now for a potential 50 basis point hike in March FOMC. Equities finally seem to be caring about the push up in yields. As we said, OPEX rolls off today. Those Vanna flows, charm flows are kind of reduced, and the S&P taking out 4,100 late in the session, and we are down to around 4060 now. Short covering within tech did seem to reach a bit of a crescendo. So obviously we're saying ARK was dislocating from what yields were doing. The Goldman Sachs data in this chart here shows us that there was a massive spike in short covering. So they look at 12-day period, and it's like the most extreme short covering that we've seen. And also crypto markets look like they're defying gravity. So, we do think there might be a window of weakness next week as all this short covering has been done. And we've got a long weekend as well in the US, which may reduce liquidity. So moving on to the trade idea, Europe. So is it time to fade Europe? If we look at Europe, it's still outperformed the US by a good 10% if we go back to November. Now, the narratives that were kind of driving the European outperformance were China reopening. So, Europe exports to China. Everyone was underweight positioning in Europe, and relative economic data surprises were coming in good in Europe relative to the US. We do think all these factors have been waning. Whereas the Euro stocks is still pretty much near its highs. So we think European stocks are vulnerable to a catch down trade as these other macro variables are turning more bearish lately. So the question is, if Europe is kind of on the precipice of a move down, what's the trade? So now the dashboard in Europe is showing buy puts, but that's based on yesterday's closing data where 1 month volatility was at around 15. So that was quite a bit cheaper than it is now. It's popped about 2 vols because the market is a bit lower. So we do think buying put spreads is probably going to be more prudent. So if we look over at our kind of dashboard here where we have all our equities, we see, DAX, FTSE, Eurostox were all here in buy put territory. Even Nikkei's up there as well. So they do still look better value than the US. If you look at the US indices, we've got NASDAQ and S&P here. So in general, puts in Europe do look decent, but we think with the pop in vol and the fact that skew has been elevated as well over the last sort of month, we think put spreads are probably the way to go. Looking at would be March, 4150, 4,000 put spread, costs around 23 points. That's in Eurostox. So you're looking at about a 6-to-1 risk reward there. And then you could do that in using US ETFs, which is the FEZ, the FEZ ETFs. That's the equivalent. The kind of put spread you could use there would be the 42.40. And again, that costs around 30 cents for a risk reward of about 6-to-1. Now, the thing about this FEZ is it obviously includes the euro dollar exposure. So if we were to see the dollar continuing to rally, we'd see euro dollar come off and you'd see the FEZ moving down harder than the euro stocks. But that is factored into the vol and it is factored into those strikes that we've picked. So that's the way, if you want to get exposure to a move down in Europe, you think Europe's been kind of elevated for too long and it's going to catch down with the rest of the markets, then put spreads, short dated, are going to give you leverage to that play. All right, that's it for today, and I'll catch you all next week. Thanks.